great to be in Puerto Rico. It's been 20 years since I was actually last in Puerto Rico, and I was on the elevator yesterday, and a lady with a Texas accent said, "We watch Succession a lot. Are you Greg?" The tall skinny guy said, "Look, I'm very flattered if you think I'm that young, but do I really have that stupid look on my face?" I hope not. First off, I want to thank John and Jarian because we met on the Claiming Countdown on Fox Business, and I was talking about a stock called VF Corp, which I'm not going to talk about today, but we are long that. That's a turnaround situation. And I said, "John, I love your stuff. Would you be willing to come on my podcast in a couple of weeks?" And he said, "Sure, I'd be happy to." And he came on for about 20 minutes, got absolute rave reviews. I can't wait to get your book, by the way. I got so much positive feedback from that podcast. I hope a lot of people went over to your site and got some of your education. One of the best educators in the business. And he introduced me to Chris, who I'm very grateful for. And Chris said, "Would you come down this week?" I said, "I'd love to. I have one ask." And he goes, "What's that?" I was like, "Could you get me on Dorado to play 18? And he said, sure enough, he delivered. We had an amazing time at Dorado yesterday. I'm just curious because this is Puerto Rico and I was around Dorado and there's a lot of big houses on the golf course. And as we were going through, I was like, how did he make his money? How did he make his money? Et cetera, et cetera. How many people in this room have made a lot of money in crypto? Yeah. So it's about 50% of the island. I won't divulge the gentleman that Chris hooked me up with, but he's made a lot of money in crypto and actually gave me a nice education on some of the apps and everything that are going to be coming down the pipe. So today what I want to do is really deliver some value. And the reason I say this also to a community that's made a lot of money in crypto is that what I noticed is that you want to have some level of diversification. Most people who are in crypto continue to expect that it will continue to go up, and that certainly may and will be true. I have no view or special edge on crypto. I'm an equity guy. But what I am noticing with the folks that have made $100, $200, even $1 billion in that group is that they are laying off some portion into other asset classes just as a hedge. So when you have your crypto winters before you have the crypto rallies, you don't have to think about it. You're kind of set up for life and you have some diversification, and then you can ride through that volatility as you have your continued uptrend. So I'm going to give you 3 picks that we have our clients in right now. 2 are pretty new positions, so you can get in without even paying me. But again, this is opinion, not advice. So I'm going to lay out the case, the fundamental case. Unlike you crypto folks, we're not looking for 1,000% in the next 12 months. We're just looking to consistently outperform over time net fees, and I think we do a decent job of that. So why should you listen to me? As John said, I have a decade and a half in the hedge fund business, long short equity. My firm is called Great Hill Capital. It's based in New York City. I live in Connecticut and New York actually. And fortunate to meet great people like John through some of the media appearances that Chris talked about. I'm most regularly on Fox Business. Who watches Charles Payne or Liz Clayman? Fantastic shows, fantastic hosts. I highly recommend them. And then prior to that, has anyone seen The Big Short? Okay, so I worked with a group called Cornwall Capital before I went out on my own. I worked directly for the gentleman played by Brad Pitt. I can attest that this gentleman, who is called Ben Rickett in the movie, his last name is different in real life, is much more intelligent than Brad Pitt, but a lot less handsome, to put it mildly. And I stay in touch with those guys regularly, some of the smartest guys in the business for sure. They do a lot with derivatives like John, and are experts in that space, if you remember from the movie, with credit default swaps, etc. Prior to that, I was with a firm called Bedford Oak Advisors, and as an analyst, I was actually put into one of our public company holdings as chief operating officer. And they said, look, I want you to go out, sell off all the non-core assets, and take that cash and buy an asset management firm. So for a year and a half, I interviewed over 100 different asset management firms, RIAs, institutional managers, financial advisors, roll-ups, etc. And what I got to see was under the hood. You know, it's amazing when you're going to give people a lot of money, they tell you a lot of stuff in order to get your money to buy their business. So I got to see all the strategies that work, all the strategies that weren't really durable, that were very volatile over time. And that also framed, besides growing up in kind of the value mafia with, my first boss was good friends with Warren Buffett, so we would go out to the annual meetings every year. Kind of grew up at idea lunches with Lee Cooperman and Mario Gabelli and that type of crew. It really gave me an insight into the business and what's durable and what works out over time and what you can count on. And we have a quality value tilt over time, but you're going to see that we don't do cigar butts. We're not just doing it for liquidation value. We want quality companies that are compounding capital over time when they're out of favor, and we're going to give you a few of those. We have developed a reputation over time for benefiting from sector, stock, and general market dislocation and periods of distress. We do post a lot of these ideas on our weekly podcast, which is top rated in the hedge fund category. You can just Google hedge fund tips with Tom Hayes, either listen on Apple or Spotify, or better, watch it on YouTube, because we do a lot of financials, we do a lot of charts, we show you how we're thinking about cash flow statement, balance sheet, income statement, and people get a tremendous amount of value. Most of our clients that haven't been referred from other clients actually come from the podcast. I had huge family offices call me, we've been listening to your podcast for a year and a half, we made a lot of money off your ideas, but that's not our business. You take that money, and if you do a good job, we'll give you more, and that's how we kind of grow our business. So we make our money buying on weakness and selling on strength. All the algos nowadays are set up to buy on strength and sell on weakness, so that's where you can actually find inefficiencies in the market if you have patience and a stomach and you do your homework. And our confidence to step in when others are bailing is rooted in deep research and the premise that the more price becomes dislocated, the more risk that has actually come out of the stock versus gone in. So what's the first thing? When a stock falls, people say, I'm not interested, that's too risky, okay? And one of the things, kind of the key secrets that we look for is free cash flow generation. And over time, if you're dealing with high quality companies that have a history of generating cash, you'll see that cash flow tends to trend up pretty steadily over time. And if you think of a chart like this, however, the price of those companies around that cash flow generation, which is all you're really paying for, is you're giving them money now in exchange for the expected future cash flow down the road. The price in public markets vacillates so widely, 1, 2, 3 standard deviations around that cash flow growth. And if you can buy it when you're not going to get it perfectly, when it's well below, and sell it when it's well above, when everyone wants it, that's how you can get some excess returns over time. So, most market participants see the volatility as increased risk. We view it as increased opportunity. So when people are running out, it's fire in the theater, we're running back in to see that they've left all the money on their seats and their purses and their wallets are still there, and that's that. So I grew up in that value tilt. Warren Buffett says, great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. What's the key word in this quote? Misappraised, and also excellent. So sometimes people just buy a company because the stock is down a lot, but it's negative free cash flow, it has balance sheet risk, and it could actually be cheap for a reason. Either it has solvency risk, or their business is deteriorated, and it's not temporarily impaired, it could be permanently impaired. And that's what you learn with experience in buying durable companies that have grown the cash flow over time. You know that cash flow is pretty solid. You understand the business, it's just prices become abnormally mispriced either to the downside or upside, either due to temporary market impairment, sectors get out of favor over time, headline risk that can take the stock price down excessively, and that's where you find. So we're all trained, markets are efficient, right? That's what they teach us in business school. Except that in the short term, the market is a voting machine which is based on emotions. Who's felt emotions when you open up your portfolio and one day it's down and one day it's up and you want to take action because it's either really red or it's really green, but in the long term, you're going to revert back to that growing cash flow. That price that oscillated too far down is going to revert to the mean. And in the long term, it's a weighing machine based on fundamentals. Short-term emotion, long-term fundamentals. So let's give you the big picture of the market. Who wants to know, is the market going up or down? We don't know, but what we do know is some statistics. So let's take the big picture. What I always tell people that I talk to, or even in the podcast, is we like to zoom out. Because on a daily basis, it's like, NVIDIA did this last night, what do you think? Let's talk about it over the next 6 to 12 to 24 months. So this is generational cycles basically over the last 100 years. And what you can see is that you have periods of sideways chop, okay? So you saw from 1928 to 1948, the market basically went sideways and did nothing. And then you had this period from 1948 to 1968 where the market went straight up. Then the 70s, from 1968 to 1982, the market basically did nothing, went sideways. Then the huge bull market, which some of you experienced from 1982 to 2000, who was participating in that, okay? And then basically from 2000 to 2013, the market again went sideways. So what drives this? This is, by the way, from Robert Slumer, CFA. He's at RBC, okay, so you can follow his work. But we were talking about this in 2020 before he put these beautiful graphics together with it. I'm not a graphic guy, I'm kind of a numbers guy, so anything that looks pretty like this, I'm like, oh, I'm gonna use that and give him some credit for. So basically what this implies is that we are halfway through a secular bull cycle that probably has another 8 to 12 years ahead. So the early 2030s to 2034, if history is any guide. This is based on demographics. So effectively in those years, like the most recent one from 2000 to 2013, you had Generation X, which was only 65 million people relative to boomers who were 80 million. So demand dropped, which is why they were able to print so much money and not cause huge inflation up until recently. Why are we getting inflation recently? Because of the millennials, the generation that came after me, is a big generation again, and they're 72, 75, they're all in the family formation years, the early 30s, which drives consumption. You turn 33, you move out of the city, you have kids, you get married, you have to buy a car, you have to buy a second car, you have to buy a washing machine, you have to buy a refrigerator, you have to buy a house, you have to pay the landscaper, and this drives growth. And every single one of these instances, 48 to 68, 82 to 2000, 2013 through 2033, 2034, is driven by a bulge in the population age 33, 34, and that boom in the economy and stock market lasts till they turn about 40, 41, 42, 43. And that's why we believe this runway is accurate moving forward. People have been saying recently the market is going to crash hard or correct hard because we just had this huge 9 or 10 week rally, right? It doesn't feel like the market's gone up every day since basically October, and everyone's been bracing for this correction. But if you, again, zoom out, what you'll see is that the market has actually made 0% gains in the last 2 years. So we had the huge rally off the COVID lows, we peaked in late 2021, and we basically gone sideways, consolidating those massive gains up until recently, and we're just now breaking out to new highs. I would say that doesn't mean you can't check back and you can't have some volatility and chop, but it's very hard to short new highs. The odds are against you, and generally, if you look in terms of the short term, breaking out to new highs, and in terms of the long-term secular bull, which we're halfway through. This secular bull doesn't mean we're not going to get 10 or 20% corrections between now and 34. We're going to get them all day long. But it does mean that you want to be a buyer, not a seller. It's not a secular type of situation like you had from 2000 to 2013 or during the 70s. To John's point about the election returns, he went back to 1952. That was really valuable data, John. We're going back to 1928, and we come out to the same conclusion. The gains this year should be more subdued, high single digits to low double digits. The average of an election year since 1928 is 11.28%. So reason to be optimistic. Here is the pattern of all election years, which is the gray line, which shows the beginning of the year is more subdued. However, in election years that the gains the year before were up 10% or more, you get outperformance up till about mid-February on average. This is not cast in stone, this is probabilistic ideas. And then you do get some type of pullback in February and March before finishing the year high single digits, low double digits. So do we trade on this? No. But are we cognizant if we have a lot of money to put to work? We may wait for softer periods to put money to work. We keep it in the back of our mind, okay? But we deal mostly on a company-by-company basis. We're not risk on, risk off, buying the market, selling the market. We're buying good quality businesses when they're on sale, and then playing the time arbitrage game to wait till they realize full value. And the reason we can wait to realize full value is because we don't use much leverage, so therefore we're never losing sleep because we're buying high quality businesses and just waiting. And most people get into trouble, like Buffett said, Charlie Munger used to say, there are three killers, ladies, liquor, and leverage. I would say ladies are just fine. Stick to one is probably a good idea. That's worked well for me. Liquor, I would, moderation, I guess, is the way to go. But leverage can kill a lot of really smart people. And some of the smartest people in the world, who remembers long-term capital management? Okay? Beware of geeks bearing formulas. Okay? These are the smartest guys in the room, they almost blow up the world. So, something to keep in mind. The 10-year cycle, this goes back to the late 1900s, 1897. The fourth year, as you can see, the second year is very weak on average. We had that in 2022. Last year, the third year of the cycle is strong, which we had last year. And then this year tends to be a little choppy, and then we finish up. I think that's going to hold true. Earnings are strong. Margins are actually starting to re-accelerate. They're expected to grow 60 basis points this year. Why? Because CEOs prepared last year for a recession that never came. They cut costs like crazy. Now they're getting the benefit of those cost cuts. And they actually were preparing for a recession that happened in 2022, where we had a technical recession, John. First two quarters, absolutely agree. That doesn't foreclose on the idea that John pointed to. There's a possibility we could get a recession this year. But when we look at the inverted yield curve, certainly the last few instances, it's a recession within 6 to 18 months. However, if you go back to a comparable period, 1980 and 1982, the last time we had a hiking cycle this aggressive, that second inversion, we got the inversion just before 2020, that second inversion actually spawned one of the greatest bull markets in history because Volcker stopped tightening, and once he stopped tightening, like Jay Powell has indicated he's going to start this year, we were off to the races. So I would be constructive here, both zooming out and in the short term based on where we are. We've kind of consolidated a lot of gains over the last 2 years. Let's get down to some picks. People talk about money contraction. That's the reason money supply hasn't contracted as much since the Great Depression, except we're $2 trillion above trend. There's still a lot of liquidity in the system that has to be worked off over the next few years. It's another reason we remain constructive. The implication of this cycle to the early 2030s being bullish is, if you look at the last two cycles, would put the S&P at 13,000 to 14,000 if it passes any prologue by 2023, 2024. So that's a lot of upside gain when you consider where we are right now. Okay, first pick, PayPal. Okay, now I hope that the 3 picks that I'm going to give you are going to cause you a little bit of indigestion, and hopefully not too much of your breakfast comes up in front of you as I go through them. So here's a stock that's down 80%, okay? And you have to think, any stock that's down 80% should have revenues doing what? Going down. What about cash flow, positive or negative? Negative. What about earnings? Okay, well, the exact opposite is true with PayPal. Cash flow per share is growing. Earnings per share is growing. Revenue per share is growing. So what is actually the problem? Why is this stock down 80-some-odd%? You can say, well, because of crypto. No one's ever going to make a payment again. We're just going to Bitcoin back and forth to each other. There may be some of that, but the problem is actually fear about declining margins and increased competition. Now, they have a business called Braintree. A lot of people say to me, well, I understand why PayPal's down. I haven't used PayPal in over a year or over 2 years. How many of you took an Uber in the last month? Okay, well, they have the Uber account, they have the Booking.com account, they have the Adobe account. It's through white label, so you don't see that you're paying PayPal. But Braintree does $500 billion of the $5 trillion of global enterprise spend around the world. And they've got most major companies in that. What happened as a result of that acquisition is their margins started to decline, even though their overall revenues were going up, their overall cash flow, their overall earnings. And the new CEO, Alex Chris, who came from Intuit, implied that that inflection started to take place in Q4. There's going to be a major conference call for PayPal tomorrow. I believe it's at 9:30 a.m. Pacific time. And he said in this conference call, he said, 20 years ago, PayPal revolutionized the world in terms of payments. On January 25th, we're going to shock the world. Now, that's a tall statement. However, this comes from a credible guy. Alex Chris ran the small business division at Intuit. He was responsible for 50% of the revenue. During his tenure there, Intuit was a 38 bagger. So if you put in $1 million, you got 38 million. Okay, that is a big trade. He was responsible for a lot of the growth. And he's been in since late September. He's going to turn around this company. PayPal generated $5.2 million of free cash flow. In the last 12 months alone, they bought $5 billion of stock. They're going to continue to do that, which means more earnings per share, more revenue per share, more cash flow per share, because there are going to be a lot less shares. So the margins are stabilizing. They're firing unprofitable customers, all these Latin American customers that they weren't making money. He fired them. He said, we want profitable growth only. They've got 428 million active accounts around the world, 10% of global enterprise spend. Their total payment volume was up 15% last quarter, year on year. For such a big company, that's huge. Revenues were up 8%. Buybacks have done. They've got a stable coin. I don't even know what that means, but people are excited about it. PayPal, USD, and Venmo's a verb. It's like Kleenex. Venmo is continuing to accelerate their Venmo team, focus on profitable growth, cut expenses, implement efficiency. Disney, another boring company. Everyone say, it's down because some of their programming is not ideal. Their parks are stale. Their creativity is dead. You've heard all the stories. They have the best parks in the world. They have the best historic content library in the world. The same thing happened in 1984. Okay, their parks were retired. They had this classic IP, but they weren't creating any new movies. The Bass family, who knows the Bass family from Texas, big oil family? They came in with a $300 million investment in 1984. They had the exact same problems. The stock had done nothing since 1973. So for 11 years, the stock did nothing. Bass came in. They appointed Michael Eisner. And the turnaround included a new technology to sell their old content library. You know what that new technology was? The VHS cassette. So they took this legacy great content they had, they repackaged it, resold it, and had a whole new income stream that lasted for 20 years. They quadrupled profits in 10 years. That $300 million became $5.8 billion. But by the way, so moving along. So same, different date, it works. Theme parks they're investing in. Just the theme parks alone is worth $80 a share. It's trading at 90 and change right now. That implies ESPN, Disney Plus, theatrical movies, Hulu, and the TV networks are worth $0. We think they're worth a lot more because ESPN actually grew their share in the last quarter. They will monetize that. They've cut costs, and we think this can actually be a double over the next 24 to 36 months. Value Act is involved. They also turned around Spotify and New York Times with their tier pricing, which they're now doing with the bundle with Hulu, Disney Plus, and guess what? They're going to sell the old content with a new technology called streaming, and that's going to drive the bus for the next 18 years as well. Final one here is emerging markets, Alibaba. This one, if the other two didn't get you to repeat your breakfast in front of you, this one certainly will. This company, from 2014 IPO to 2022, they grew revenues per share by 900%, cash flow per share by 500%, earnings per share by 500%. Guess how much the stock went up? 0%. Okay, there's been one instance of a company like this that I can think of that was comparable was Microsoft. Microsoft from 2006 to 2013, they doubled revenues. Cash flow was up, per share was up 200% over that period. Earnings were up 120%. The stock did 0. Now, here's what's interesting. Over the next period, after those years of sideways consolidation, the stock was up 1,500% under Satya Nadella. Do you know Satya's performance over that next period was not much greater than Ballmer's performance when the stock did nothing? It got re-rated with the multiple. That's what we think is happening with PayPal and Disney and Alibaba. We're at capitulation levels, ladies and gentlemen. Just to give you this last data point here, foreign buying is at its lowest level since 2015. You can see here what happened the last time foreign buying was this low. No one wanted China stock. You had a 5-bagger over the next 5 years. We think we're at that level of capitulation. And we're back to these levels. That first box from 2014 to 16, revenues per share were $6 per share. Now they're $57 per share. Cash flow was $2.93 per share. Now it's $12.15. And earnings per share was $2.60. Now it's $9.12. So in the short term, the market is a voting machine based on emotions. That's where we are now on sentiment. In the long term, it's a weighing machine based on fundamentals. Someone else already paid the price of the last 9 years of 0% returns and huge business improvement. They're changing policy. You've seen some of the headlines in the last 24, 48 hours. The government is blinking just like they did on COVID zero, and this is going to start to take off. This is also a weakening dollar play, emerging markets in general. We buy high quality businesses when they're on sale. So with that said, thank you so much. Obviously, opinion, not advice. This is what we're doing, not what you should do. Talk to your financial advisor. That's the podcast. That's how to reach me. Thank you so much.